Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The Fed goes big. Global stocks rally after Jay Powell leads colleagues to an outsized cut in US interest rates, but he cautions on the speed of further easing.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
So does the Fed cut open the door to another move lower for the Bank of England? Most economists see the BOE staying put, but with underlying UK inflation still a concern. Plus, Israel declares a new phase in the war with regional Islamist groups as Lebanon is hit with a second wave of exploding electronic devices. So yes, the Fed went big and US markets struggled to get a grip on the narrative from Jay Powell, the statement and that decision as they tried to square the market's expectations with the dot plot and the forecasts. But in Europe and Asia, the message is clear. It is risk on the back of this cut coming through from the Federal Reserve and what it signals about the health of that economy as well, with Jay Powell stressing that the US remains in a decent position in terms of economic growth, still expected around 2% by the end of this year. European futures looking to add more than 1% as we lead up to the open, of course, here in Europe this Thursday. FTSE 100 futures looking to add 78 points. Stateside, the S&P E-minis pointing higher by a full percentage point as well after modest losses again after a very choppy session yesterday. Nasdaq futures looking to add 285 points, up a full 1.5%. Let's flip the board and look cross-asset. Yields actually edged higher yesterday on the back of the press conference from Jay Powell. Currently 363 at the front end on the 2-year with a move of just 1 basis point. The pound, of course, in focus for us today. The switch now to the focus around the BOE expected to hold. But let's see how much division there is amongst the MPC and whether indeed this 50 basis point cut from the Fed does move the needle in any way. 132 right now on the pound. Gold remains at those record levels. 2,564 around those record levels, up 0.2% so far in today's session. Brent, $73 a barrel, just up 0.1%. Some conflicting pressures and counter pressures coming through for oil around the demand picture out of the US, but also, of course, Middle East tensions. Let's cross over right now to Asia. Min Min Lo standing by for a check in the markets in Hong Kong. Min Min.
Yeah, it's risk on here all across Asia today. The Asian benchmark up 1.3%, and it's led by the Nikkei 225, punching up 2.7% on the back of the weakening of the yen. We're watching the yen very closely because it did erase most of the gains after Jay Powell's comments, which suggested that the Fed maybe wasn't as dovish as many people had been hoping for, and the BOJ at the same time not as hawkish as people were hoping for. The BOJ decision tomorrow that we're watching very closely, economists expecting rates to be unchanged, but given that the dollar yen is now rising up 0.6%, moving away from that danger zone of 140, 141, could that mean that a rate hike is now back on the table? That's what we're watching. Flip reports. Take a look at the China markets. It's pointing upwards across the board as well. Of course, PBOC now in the window to cut rates finally after the Fed moves. And also we had that upbeat consumption data coming out of the Mid-Autumn Festival as well. The Hang Seng Index up 2% after the Monetary Authority had matched those rate cuts by 0.5 percentage point here in Hong Kong as well. And of course, that's benefiting the beleaguered property developers that has been slammed by the high borrowing costs. There you go, the property index up 3% today. The 10-year yield still pointing down for an 8th straight day. Tom?
OK, Min Min Lo in Hong Kong with a check in the Asian markets, risk on, as you can see. And we lead up, of course, to the BOJ decision, as Min Min was saying, on Friday. Now, the Fed has opted for an outsized interest rate cut, as we mentioned, designed, of course, to preserve the strength of the US economy as risks mount to the labour market. Speaking after the meeting, Chair Jay Powell said the half-point cut reflects the central bank's risk management approach as they aim for that soft landing.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. the labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Right, let's get some analysis then from Bloomberg's Markets Live team. Garfield Reynolds joining us. Garfield, they went with 50. The economists got it wrong. The traders largely got it right. How does that set us up in terms of how we think about the market reaction? Risk on right now in Asia. European futures pointing higher, as are the US markets after a choppy session. Your take on this decision?
Well, the decision is, a lot of the confusion that's being caused is that the way Powell was framing it is essentially they probably should have gone 25 basis points in July. So it's almost like they see what they did overnight as being delivering 2 25 basis point cuts, not one 50 basis point one. So for them, 25 basis points of meeting going forward is the most they expect to do over the coming year or so. Meanwhile, the bond market is expecting at least one 50 basis point cut, maybe even a couple in the coming year. So that means that bonds and the Fed are a little bit at odds. Stocks, they're loving it because they see, they're getting that message that all that is needed is gradual easing. That's going to assure a soft landing for the economy. That's good news for equities. They like the idea of lower interest rates, but not rapidly lower, because that, to them, signals that they get some help from the Fed, but they get a lot more help from the fact that the economy is going to remain strong.
Garfield, are we also getting a reminder today that the impact of this cut is going to be felt more outside the US than within the US? As we see the rally in Japanese stocks up 2.5%, Hong Kong as well doing very well in terms of the tech index, currently up 3.4%. We look ahead to the BOJ. Does this ease the pressure on central banks beyond US shores and indeed asset classes with a focus on equities?
Yeah, I mean, very much so. And in fact, you could argue that, as you were saying, assets outside of the US, for them, it's even more important that this is a decision that comes with the message that the US economy is still, as Jay Powell put it, doing just fine. That is what the small open Asian economies, for example, which still rely very much on exports to the US, even more so with China sagging. That's what the message they want to hear. By the same token, places like, the Australian Central Bank is happy that it doesn't suddenly face pressure to cut. A lot of other central banks, they can see a path to easing now that the Fed is gone, but without that threat that we're going to have a panic. After all, at times when there have been concerns about a global shock, that's when the US dollar rises, even when interest rates for the US are going down. That's off the table as well. So kind of best of both worlds as far as central banks and markets are concerned, especially across Asia. And it's looking pretty good for Europe as well, at least as far as the futures are showing for now.
It certainly is, as things stand. With the important context on the back of this cut, what it means globally as well. Garfield Reynolds with the analysis from our Market Slides team. Garfield, thank you. Now to the Bank of England. We're talking about the impacts, of course, on other central banks. The BOE is, of course, up next, likely to decide against cutting UK interest rates for a second straight meeting when it, of course, makes that decision later today, maintaining a patient approach to reversing the most aggressive policy tightening in decades. Joining us now, of course, for the preview is our UK correspondent, Lizzie Burden, who's building up to all of this for us, and we'll be outside the Bank of England later. Lizzie, talk to us about expectations around whether or not the needle does move for the BOE, given that 50 basis points came through from the Fed, unexpected by economists. Does it change the thinking of the MPC?
Well, far be it from me, Tom, to suggest that central bankers don't have their own minds. But, of course, the Bank of England is affected by what the Fed does via the exchange rate. If you have stronger sterling, as we've had all year, it makes exports more expensive, which holds back growth, which encourages rate cuts. But you also saw in yesterday's CPI data services inflation ticking up, and it was less than what the Bank of England had forecast. It was in volatile areas like airfares, but nonetheless, it is what the BOE's said it's concerned about. And we've had this cautious tone from Andrew Bailey, most recently at Jackson Hole. So today, the expectation from economists is still that the BOE will keep rates on hold. The split, though, is likely to be even less finely balanced than last time. So it was 5-4 last time. We've got a new unknown quantity on the MPC today in the form of Alan Taylor. Actually, economists see a 7-2 split for a hold today.
OK, what about the outlook? What about clues around the outlook for the BOE then? If they do indeed hold, are we going to get any signals, any indicators today?
Well, this is perhaps one of the reasons why they will hold, because there isn't a press conference or a forecast to explain what they're doing. However, they may nod to lower inflation and lower growth ahead in the communications around the decision. Beyond today, what markets are expecting are cuts in November and December, and then 5 cuts through 2025. It'll be interesting to see how the pricing changes off the back of today. And of course, on October the 30th, we have the new Labour government's first budget. So by the November meeting, the economists at the Bank of England will have more idea about the shape of the economy, especially because the expectation is this is going to be an austerity budget with potential tax rises, which could squeeze growth.
OK, Bloomberg's UK correspondent Lizzie Burden, thank you very much indeed with a preview of what to expect from the BOE and what to scrutinise with that decision, of course, coming later today. And Lizzie will be on the ground to cover all of that for us. Here's what else we'll be thinking about today then. 9 a.m. UK time. We're talking about the ramifications of this Fed cut and on other central banks. The Norges Bank in Norway comes through with their decision at 9 a.m. UK time. We will break that for you. And then in the emerging market space, an interesting one there, 12 p.m. UK time, it's Turkey's rate decision. An expectation, of course, that a cut from the Fed does ease the pressure on a number of these EM central banks. 1:30 p.m. UK time, we know the focus now for the Federal Reserve is less on inflation and more on the jobs market. That's why the importance is there for this US initial jobless claims number that will cross 1:30 p.m. UK time. Again, building out our picture and understanding of the health of the labour market of the US. You can get a roundup of the stories you need to know to get your day going. In today's edition of Daybreak, terminal subscribers can go to DAYB Go on the terminal. Coming up, a wave of new exploding telecoms devices in Lebanon, ramping up tensions between Israel and Hezbollah. We have the latest from the region next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, more telecom devices, including walkie-talkies, have exploded in Beirut and other areas across Lebanon. The country's health ministry puts the total death toll at least 26 people. Israel's military has declared, meanwhile, a new phase in the war and says troops are to be diverted to its northern border. Let's bring in Jemana Pasechi, then, our Horizons Middle East and Africa anchor for the latest. Jemana, walk us through what happened yesterday in Beirut, more exploding devices. What was the impact? What do we know were the causes at this point?
Another wave of explosions rocking through Beirut and other cities around Lebanon yesterday as well. The health ministry putting the total number of casualties at 450. In total, 26 people have been killed. This time, the catalyst came from walkie-talkies that were triggered across all areas. They were triggered in homes, they were triggered in cafes, groceries, and even in people's cars as well. And a few human rights groups are beginning to note on the indiscriminate nature of these attacks, because what is happening is bystanders and even family members of people who were holding or had access to these walkie-talkies are also some of the casualties that have been sent to hospital. But experts say that this is just another case of this sophisticated and pre-planned operation relying on placement of explosive material into those pagers that were detonated on Tuesday, into the walkie-talkies that were detonated yesterday, that these Hezbollah group members had been using. Now, as we have spoken about in yesterday's reporting, Israel has not taken any responsibility for the incidents. They have not commented on it. But what we did get yesterday were lines from the defense minister, Yoav Gallant, saying that a new phase in the war is opening up and that they've started to redeploy military forces towards their northern border. And again, this is on back of is the Israel Prime Minister Netanyahu's comments on Tuesday saying that their new war objective is to get that security achieved on the northern border with Lebanon. And it seems as though the focus now has squarely moved to that front. On the Lebanese perspective, of course, Hezbollah are now on the defensive. The chief commander, Hassan Nasrallah, is expected to give a speech later today, so we will be watching out for that.
Yeah, that seems very significant, doesn't it? The troop deployment to the north of that border in Israel, and around 150,000 civilians on both sides in Lebanon and Israel being displaced around that border. What do we know about the US reaction, Jemana, to all of this?
Well, all of this coincided with the trip that the U.S. Secretary of State Anthony Blinken was making to the region. He was actually in Cairo and he was asked about the events. And he said that the U.S., and this is a quote, did not know about nor was involved in these incidents. We're still gathering the information and looking at the facts. So it seems as though the U.S. were not aware of this pre-planned operation and that they had not given the green light for this intelligence operation to go ahead. But what we do know is that they are still intent on achieving a diplomatic resolution. And what Secretary of State Anthony Blinken went on to say yesterday is that he does not want the events of the last couple of days to take the focus away from their desire to get to that ceasefire deal in Gaza because of the risk of that full-blown conflict. Now, equally, I also want to flag, and we spoke about this yesterday, one of the casualties was the Iranian ambassador to Lebanon. And even though the embassy put out a tweet saying he's recovering well, it is worth pointing out that Iran also have made some of their own statements. Their envoy to the United Nations said they reserve the right under international law to take required measures deemed necessary to respond to such a heinous crime and violation. So you've got to think about all of the different pillars here in the region who are looking at the events of the last couple of days as a serious escalation.
OK, Bloomberg's Horizon as our anchor, of course, Jemana Pasechi with the latest, joining us out of Dubai in terms of what is unfolding in that region. Jemana, thank you. Meanwhile, US authorities, and we've been talking about Iran, have accused Iranian hackers of emailing stolen information from Donald Trump's presidential campaign to President Joe Biden's campaign team, as well as to journalists. The operation appears to be an effort to dupe people working for Biden's campaign to act on so-called spear phishing emails. Investigators don't have evidence that anyone from Biden's campaign relied or replied to the emails. Coming up, South Africa's inflation dips below the central bank's target for the first time in 3 years. That's ahead of today's rate decision. We are live in Johannesburg for a take on an important emerging market and the central bank thinking. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, South Africa's central bank is set to kick off an easing cycle when it meets later today. It's widely expected to lower its key rate by 25 basis points to 8%. Let's get more from Johannesburg then with Bloomberg's chief Africa correspondent Jennifer Dabasaja. Jen, how might the CPI print, the inflation data of today, then tie in to the thinking of the Central Bank of South Africa? Do they still go with 25 or might they move a little faster, a little more aggressively?
Right. The consensus, Tom, among most economists and analysts is that we will see the SARB, as you mentioned, bring the rate down from 8.25 to 8%. And the inflation picture that we did get, though, on Wednesday was surprising to the downside for many people, and especially if you consider what we've heard from the SARB, the South African Reserve Bank. This falls below their midpoint target range, and this potentially is a reason for them to be upbeat and consider rate cuts today, because they've been working to do this for quite some time. Back in 2022, inflation was just about 7.8%. So they have in some ways defeated or actually, come quite far on inflation, but they're still quite cautious, and that's clearly what we are hearing from a lot of analysts. They want to be cautious moving forward. They're paying close attention to any inflationary risks that are out there that could potentially come from higher fuel costs. And of course, they are watching closely to what the Fed did. But yes, the consensus is that we will see a rate cut today, but it will not be as aggressive as you were just mentioning there as what we saw potentially from the Fed.
Okay, still likely a quarter-point cut coming through from the South African Central Bank. Of course, we'll break that for you when it comes through. Jen, when we talk about the Fed, and you touched on this, there is a view now from many out there that indeed this cut is more consequential for nations outside of the US than domestically within the US. EM is squarely within the mix there. What is your sense in terms of talking to people on the ground around how broadly African central banks are thinking about the consequences of this jumbo cut from the Fed and whether it does allow them more space to act?
Right. It's fascinating, Tom, because over the past few months, as we've been speaking to a lot of analysts and economists, I mean, they have been squarely watching what the Fed is doing. And so the fact that the South African Reserve Bank joins a number of other central banks globally to have their monetary policy committee is very timely for them. And they were paying close attention to this. But they also were already in their meeting prior to this announcement that we got from the Fed. And so potentially they already saw room to ease up. In terms of some of the other central banks that we're looking at across the African continent that could potentially join South Africa in easing, we could see Mozambique, Kenya, Ghana, and Eswatini, because similar to what we see here in South Africa, inflation has potentially peaked, is coming down, and also their currencies have been able to stabilize, in some cases actually strengthen against the dollar. The picture, though, is different when you look at countries like Nigeria and Angola. Of course, they are paying close attention to what is happening geopolitically, how that affects their revenues from fuel. And they're also paying close attention to what is happening with their currencies. We've seen the Naira in particular still weaken quite a bit. And so the expectation by most analysts is that at least in Nigeria and Angola, potentially we see a pause and not yet a cut, unlike what we are expecting to see here in South Africa and elsewhere.
Jen, thank you very much indeed, with the context, of course, and a different perspective on the implications of this Fed cut, with a focus, of course, on what happens next for the South African Central Bank and other central banks in the region. Jen Zabasaja joining us out of Joburg. Now, the Global Vaccine Alliance, known as Gavi, is purchasing 500,000 Mpox vaccines from Bavarian Nordic for African countries hardest hit by the lethal outbreak. Gavi's CEO told us the jabs are for distribution this year.
So this is going to be a targeted vaccination. This is not going to be a population-wide vaccination. That is very clear, and the guidance from the World Health Organization is cascading into country strategies. That is what has been decided as the most evidence-based and appropriate response. But having said that, this is an evolving situation, and we have to look at the guidelines and the vaccination strategies as more information about the epidemiology emerges.
Let's get back to these markets and check in on how the FX space, gold and Bitcoin are reacting then to this jumbo cut from the Federal Reserve. Not expected, of course, by most economists. The focus right now on the Japanese yen. The weakness has pared a little, still down 0.3% versus the US dollar. It had got to that 143 level, now 142.81. The rate differential between Japan and the US has, of course, narrowed on the back of this Fed decision. We had the BOJ decision on Friday. How they signal future hikes, of course, will be consequential. The pound in focus ahead of the BOE decision, 132 right now versus the US dollar. Gold remains at these record levels, up 0.4% for the yellow metal at 2,568. And Bitcoin getting a lift as well on the back of the rate cut, close to 62,000 on the biggest cryptocurrency, up 3%. Coming up, we will continue our analysis of that Fed decision with Janet Henry, HSBC's global chief economist. Stay with us for that conversation. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The Fed goes big. Global stocks rally after Powell leads colleagues to an outsized cut in US interest rates, but he cautions on the speed of further easing. Does the Fed cut open the door to another move lower from the Bank of England? Most economists see the BOE staying put, but with underlying UK inflation still a concern. Plus, Israel declares a new phase in the war with regional Islamist groups. That's as Lebanon is hit with a second wave of exploding electronic devices. Let's check in on the markets right now. US equity markets, US traders seeming to struggle to get a grip as to the decision yesterday from the Fed. Not the case when it comes to Asia and Europe. The markets now, investors in these regions with the bit firmly between their teeth. This is risk on right now on the back of the 50 basis point cut from the Fed. European futures pointing high by a full percentage point. The FTSE 100 looking to add 70 points. S&P E-minis now deciding that this is indeed a dovish move from this Fed in terms of the context that Jay Powell gave. Expectations that the soft landing for some has been reinforced with 2% growth being the forecast. S&P futures pointing up by around 0.9%. NASDAQ futures also looking to rally 1.4%. Let's flip the board. Look cross asset. Treasuries not moving much today. Yields actually moved a little higher yesterday. The pound in focus for us today, of course, leading up to the BOE decision. Not expected, of course, to cut for a second time of the cycle. But will we get any hints, any signalling ahead of the next two meetings? 132 on the pound. Gold remains at near these record highs, up 0.4%. So popping in the session, 2,569 per troy ounce. Brent up 0.2%. There is, of course, the Middle East tension factor to build into this, but also continuing concerns about the demand picture out of the US on the other side of the equation. 73.79 on Brent. Now, the chair of the Federal Reserve has warned that the larger than forecast half-point cut in US rates is not a new pace for the central bank.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Joining us now is Janet Henry, Global Chief Economist at HSBC. Janet, thanks so much for joining us this morning. Your take then, the key takeaways for you from this 50 basis point cut from the Fed.
Good morning, Tom. Well, it was more or less priced in. The headlines were always that economists weren't forecasting it, but it was pretty much priced in, largely as a consequence of some news articles in the course of the last week. But my takeaway was that certainly Chair Powell is at the dovish end of expectations. The other takeaway is that they are responding very much to what happens in the labour market. And yes, he sent that signal that people shouldn't look at it and say this is the new pace. It's back to data dependency. So it did kind of give a sense that they're perhaps a little bit more worried about the labour market than they're letting on. But as they always say, it will be dependent on the data for the next rate decision. And ultimately, that's what people are now focusing on. How far will they eventually go and at what pace?
OK, and I want to get your views and unpack your take on how that labour market in the US is evolving. But before I get there, the mismatch that we're seeing again in terms of the forecasts, the dot plots from the Fed, expecting another 50 basis points by the end of this year versus the markets, which are closer to 70 basis points. Where do you and the team land on that mismatch?
Well, I think there is the idea, and certainly this is something that Powell talked about a lot in the meeting yesterday. It is the idea of getting back to a sense of what is more neutral, that level of rates that's neither, forcing the economy to grow a bit more quickly or slow down a little bit more swiftly. What is the kind of new equilibrium rate for the economy? They don't know what it is. The markets are betting on the idea that they'll have to go, to quite a low level, another 8 rate cuts, almost by, kind of in the course of the next year. We think it will probably be a little bit less. The economy is still in a pretty firm place. In fact, the whole Fed forecast, the projections, these are averages, the ranges are around them, is a little bit too perfect. Going back to 2% inflation, 2% growth, and quite a lot of rate cuts. Relative to the Fed forecast, we've got unemployment a little bit higher, inflation a little bit higher, and the more that they cut rates, the more the economy might be a little bit firmer. So we have actually got, certainly over the next year, about 50 basis points less than is currently priced into the market.
OK, 50 basis points less. I'm not quick enough to do the maths on this, but they see 4.4%.
We've got 6 more 25 basis point cuts.
OK.
Yeah.
OK, because they see 3.4% by the end of next year. You don't think it gets to 3.4%?
No, we've got the last rate cut in June. We've got 25 in November, 25 in December, and then they keep cutting it a 25 basis point rate until the June meeting. But it will depend on the data. If we get a shocking payrolls in the next month, then November, we'll be back to talking about could they go 50 at that meeting. It is very much contingent on, at the moment, the labour market data. But remember, inflation is still above target. If we get an inflation surprise, that could tame what they do as well. But at the moment, I think it's reasonable to assume until they get back to something, as he kept saying, more neutral, we are probably on a 25 basis point per meeting kind of trajectory.
What is the health of the labour market then? The data seems to be mixed, Janet. Do you have clarity on how this labour market in the US is evolving?
You don't really, because, often economists and indeed policymakers look at the labour market and think of it as a lagging indicator to what is happening on the activity side. But we have seen over the last few months some good news on inflation and suddenly a bit more of a slowdown in the labour market. But we don't know how much because we've just had this series of quite significant revisions. And the sense seemed to be that there might be some further downward revisions for the course of the last few months. But that's really based on what's happening to payrolls and the unemployment rate. And we know that on the unemployment rate, it's also driven by the supply of workers, which has been quite strong because of the immigration story, against a backdrop where employment is still growing. It's just not growing as quickly as it was. But jobless claims are actually still at very low levels, nothing like what you see during a recession. And even quits rates and jolts rates are still stronger than they've been over the course of the last 10 years or so. So, yeah, it's slowing down. You would expect that to continue. But if the Atlanta Fed is right and the economy is still growing at 3% in the third quarter, then probably that is suggesting that productivity is improving, is better. So slowing, but not collapsing.
OK, Janet, to the UK then. It's the BOE decision today, of course. Before we let you go, does the 50 basis point cut for the Fed at least move the needle in terms of the MPC? I mean, growth here is flatlining, unemployment is ticking up. We could get an October budget that is fairly restrictive if tax cuts, or tax hikes, I should say, come through. Is this a BOE that needs to go with another cut today?
I don't think it necessarily needs to, obviously, especially given that the currency has moved and, we have seen a move down in oil prices and everything. The balance of risks have shifted a little bit. But the difference with the Bank of England, it's not priced into the markets. It's not just the economists that are going for unchanged. The market only has a small probability of a rate cut. Our view is that they would rather wait until November, wait for the budget, wait for their new set of projections, and certainly everyone's expecting a rate cut in November. But there's always a degree of uncertainty with the Bank of England that we typically don't get with the Fed, although admittedly we did have it over the course of the last week.
Yeah, indeed. Well, Janet Henry, thank you very much. Indeed, always smart analysis on this global economy. Global chief economist at HSBC. Really appreciate it with the deep dive on the Fed and looking ahead to the BOE. Now, Bitcoin is up this morning, joining the risk-on mood after the Fed made that outsized rate cut. Here's some of the key crypto players discussing the market at the Token 2049 conference in Singapore. Take a listen.
Regulation itself cannot be the be-all and end-all, right? So you have smart regulations and you have not so smart regulations, right? Rather to have regulations that get it right from the start instead of having regulations that really just focus on the risk, and that inhibits the growth of that sector even further.
Let's just face it, Donald Trump is a polarizing person. He's for it. It could touch off an avalanche of people that are against it. And so that's something people that are working alongside of Vice President Harris, whether it's Mike Novogratz, myself, Mark Cuban, really want to prevent that from happening. We want crypto in the U.S. to have a bipartisan standard strained from the political tribal conflicts.
What we want to see is more money velocity, more utility for money in the economy. And I think lower interest rates definitely support that. And so we think this kind of move down in rates should be a really positive catalyst for growth and adoption in stablecoins.
Okay, so the move lower in rates could be a catalyst to adoption within crypto. We check in on the crypto markets right now. Some of our guests there speaking to us at the Token 290 conference over in Singapore. In fact, some key names and key players there. Let's check in on the markets right now in terms of how crypto is shaping up. They are benefiting and taking, of course, some tailwinds on the back of this 50 basis point cut from the Fed. Bitcoin close to 62,000 right now, up almost 3%. Ether, the second largest token by market cap, up 3.6%. And Solana gaining 3%. So a rally there for some of the key crypto tokens currently on the back of this rate cut. And of course, they're also talking politics because, of course, Trump has lent into the crypto space as well ahead of that November election. Coming up, we're going to look ahead to the BOE's rate decision due, of course, in a few hours' time. Traders are waiting more hints from Governor Andrew Bailey on the rate path. This is Bloomberg. Welcome back. Now, the Bank of England will most likely hold its key rate at 5% today. That's after last month's cut. Joining us now from outside the Bank of England is our UK correspondent, Lizzie Burden. Lizzie, all the excitement around the Fed, it was a split decision. Not as much excitement around the BOE. I'm sure you can jazz it up for us. What are we expecting?
Well, Tom, it is more exciting now that the Federal Reserve's cut by 50 basis points. You could argue that a dovish Fed and a hawkish Bank of England equals a stronger pound, equals more expensive exports, equals weaker growth, and there's an argument for the BOE to cut. However, you could also argue that the Fed's done a bit of the work for Andrew Bailey and that Jay Powell managed to thread that needle and say they are going to have a soft landing, so there's no need for Threadneedle Street to threat today. Add on to that yesterday's inflation data, a pickup in services inflation, and that is what the BOE is worried about. You had that cautious note sounded by Andrew Bailey at Jackson Hole, don't forget. And this is why most economists still reckon that the BOE is going to keep rates on hold today with an even less finely balanced vote split than last time. Remember, we've got a new MPC member today in the form of Alan Taylor. It'll be interesting to see how he votes. Where you could get a surprise is on quantitative tightening, the pace of bond sales, whether they ramp it up a bit. Some economists expect that, but even there, Tom, a majority of economists for us reckon that the pace is going to stay at £100 billion a year, but they will be watching that very closely from Downing Street because, of course, it has an impact on how much wiggle room the new Chancellor Rachel Reeves has at her budget on October the 30th.
UK correspondent Lizzie Burden with a preview of the BOE. Lizzie, thank you very much indeed. At this point, let's bring in Jackie Bowie, Managing Partner and Head of EMEA at Chatham Financial for more analysis. Jackie, good morning. Thanks for joining us. When we look at the growth picture in the UK stagnating, when we look at unemployment ticking up, when we look ahead to the October budget, maybe additional tax increases, is the Bank of England setting itself up for a policy mistake if it doesn't cut today?
Yeah, well, I think obviously we had this discussion last time round where the decision was much more finely balanced. But at that point, the economic data actually looked better for the Bank of England when they did the first cut of 25 basis points. As we look at it today, and even excluding all this influence from the Fed and the big 50 basis points that came through last night, the market was not expecting the Bank of England to cut rates today. And I think with the inflation number that came in yesterday, again, the headline looked fine, but scraped behind that a little, and that services number at 5.6% still looks like inflation is not where the Bank of England need it to be. So that will be the focus, and we're expecting them to stay on hold.
Jackie, on the services component then of inflation, what is keeping services above that 5% level that you say is of concern to this MPC, to this BOE?
Yeah, so there's been a few different influences on that number. I mean, the report that came out yesterday, if you dig into it, actually one of the big swings was actually airfares. So a big move from a kind of minus impact to a plus impact, which impacted the headline number. So if you look at that, you think, well, airfare prices are quite volatile, so it's not like that will continue to have an influence on an ongoing basis. But the other thing we need to think about is the impact of the year-on-year change in the utility cost. So the UK's energy price cap will move up around 10% in October, and you'll start to lose the beneficial effects of the fall-off in energy prices that we've had all year. So there's also a little concern that some of the headline inflation numbers might start to look a bit higher. So when we get the Bank of England today, what we'll be looking for, again, is also any commentary that they're making on the outlook. You commented on the GDP situation, and absolutely, the GDP numbers through the summer have not been great for the UK. So a little bit of stagnation in the economy combined with the situation that inflation is still not under control. So again, on hold for today, but the market's still pricing in, two more cuts this year. I think that might be a question mark depending on where inflation lands.
OK, so that's a question mark over the market pricing around 2 additional cuts from the Bank of England. As you look ahead to 2025 then, Jackie, with that view on the growth picture, how do you see that evolving and the impact that these cuts will have? Do you see a pickup, a more meaningful pickup in growth next year for this UK economy, or does it remain in this rather stagnant state?
Yeah, so the mechanism in terms of falling interest rates really feeding through into the real economy is actually quite lagged. And of course, we've seen that on the upside, right? Where you were seeing rising interest rates through 22 and 23. And actually, especially the US economy, still showing really strong growth numbers. Now we're seeing the impact of those rate rises coming through. So there is quite a long lag effect. So I think this is one of the concerns as economists make their predictions, which is even if we get 2 more cuts this year, will we really feel the beneficial effect of that in 2025? Probably not. Layer on top of that, the comment you made about the upcoming budget and the expectation that fiscal policy is going to have to be tightened. And I think you've got a kind of squeeze from both sides with regard to interest rates still being relatively too high and the fiscal position not being beneficial to support growth.
Jackie, given everything that you've said around the economy, the evolution of inflation, and how you see the BOE's reaction function and that delayed reaction, if they remain relatively conservative, maybe that's the take from some, not necessarily consensus. If they remain relatively cautious, maybe that's the better way to frame it in terms of how they move low on rates this year, does it mean they end up having to do more next year?
Potentially, maybe as we go into the second half of next year, if we really see the economy, worsening still. I mean, 1% growth for the UK, it's not really a lot to get excited about. But if it starts to look even worse than that, and then, of course, looking over to the labour market side as well with regard to unemployment, you could then see the Bank of England potentially trying to play catch up towards the second half of next year. But it's a super fine balance between when the impact of rates will start to hit the real economy and, as I say, that underlying services sector inflation, which is still causing concern.
OK, Jackie Bowie, Managing Partner at Chatham Financial, with really great analysis and context around the different components feeding into the decision for the BOE today, but looking ahead as well. Jackie, thank you. There is plenty more coming up. I'm going to break down this decision from the Fed for you with the numbers, with the data, and, of course, reflect on how the markets are reacting to that. Stay with us. This is Bloomberg.
Definitely did compromise here, but I don't see there's any big concern from the Fed that they need to continue to cut interest rates by 50 basis points meeting after meeting. They're going to be moving slowly and gradually.
If inflation doesn't continue to subside as the Fed projects, is that at some point markets may price in a bigger move than the Fed is able to deliver, and that potentially would disappoint markets.
The impact on Asian currencies, however, is going to be somewhat mixed, I think. I think it's worth emphasizing that the interest rate differential in the dollar's favor remains quite large. And even if the Fed were indeed to cut another 50 basis points by year end, it's still going to be quite large in the dollar's favor.
So the most important thing is the jobs market. Basically, if you look at the ADP, you look at the unemployment, you look at the NFP, if those numbers don't look good, then it doesn't really matter as much what the Fed does. People are going to sell the market. If those numbers look good, then, probably 25 basis points per meeting is the default.
OK, of course, the Fed did go with 50. That was called by Bill Dudley, of course, former New York president, Fed president. He made the call. He made a convincing case, at least that will be the take from some, that they should go 50, that they would go 50. In fact, of course, that is what the Fed did do. They went with that jumbo cut. JP Morgan's team as well, also getting the call right with their view that they would go 50. That's what came through. Here's the dot plots then, because this was also part of the mix yesterday. You had the statement, you had the presser from Jay Powell, and of course you had the forecast adjusted as well. Fed officials now see an additional 50 basis points of cuts between now and the end of the year. 50 basis points. Another 100 basis points is what's expected and flagged by these dot plots, the forecasts for 2025 over 8 meetings. They see now, by the end of this year, rates down at about 4.4%. By the end of 2025, Fed officials on the dot plots see rates down to about 3.4%. And here's what's interesting as well. In terms of the longer-term rate, the expectation is that you'll be around 2.8, 2.9%. So just bear that in mind in terms of your thinking about it. It's a guide. It is, of course, in no way locks these Fed officials in. Let's flip the board and have a look at the market pricing, though, because there is a disconnect, again, in terms of the dot plots and the forecasts and what the markets are pricing. Markets are pricing in more. It's not the first time that's happened, of course. Markets are pricing in about 70 basis points of cuts, by the way, by the end of this year. Around 66 basis points the last time I checked, including 150 basis point cut. Again, this is the projection in terms of where you get, the dot plot projection in terms of where you get to, 4.4% in terms of the September move, of course. The markets are disconnected from the dot plots. Does that matter? To what extent will that close at all? And does the Fed need to address that in its communications going forward? Again, this is the pricing that's coming through in terms of the market expectations on this. Let's have a look at how the market moved around this. It was a choppy session. It's risk on right now across Asia. And in terms of European futures, US futures also in positive territory. But it's a very choppy session yesterday on the back of this decision from the Fed. Initially risk on that 50 basis points. Then it started to pair some of those gains during the press conference that Jay Powell laid out, including his insistence that it does not mean necessarily that this is the playbook for the Fed going forward, 50 and 50. He said that is not how to think about this necessarily. Some of those gains were paired. Right now, though, it's risk on in Asia, risk on in terms of European futures and US futures. We'll be walking through all the consequences around this, of course, and how to position. Coming up later, we're going to be speaking to the transport sector in the US, but up next, it's the opening trade. This is Bloomberg.